50 miles of asphalt, zero inventory, zero perishable goods, zero customer service line. You paint some lines, you put up a booth, and you collect money from strangers for the rest of your life. That's the pitch. That's what pulls people in. No employees to manage in the traditional sense, no product to reinvent every quarter, just a strip of concrete and a transponder reader doing the collecting for you. Here's the paradox. The road that makes the most money is the road nobody wanted built in the first place. Toll roads exist because the free alternative is worse, congested, slow, full of stoplights. The moment the free road gets good enough, your road becomes a 50-mile parking lot with a subscription fee and nobody renews. You're not selling pavement, you're selling time, and time only has value when the alternative is miserable. So the real question isn't how much traffic your road gets today. It's whether some city council 20 years from now decides to widen the free highway next to you and erase your entire business model overnight. Nobody puts that risk on the brochure. And here's the part that should really unsettle a prospective buyer. The contracts governing these roads run so long that the person signing the deal will, in almost every case, be dead before the concession expires. You are buying an asset whose entire risk profile plays out after your own involvement ends. Someone else inherits the fallout. That's not an incidental detail. That's the business model. Think about how strange that is compared to almost any other business. A restaurant owner feels a bad month within 30 days. A toll road owner can go a full decade without feeling the consequences of a decision made on day one, because the debt is amortized so far into the future that the warning signs show up as a footnote in a bondholder report, not a phone call demanding action. That delay is exactly why the asset attracts a very specific kind of buyer. Not the operator who wants to run something, the allocator who wants to own a cash flow stream and never think about it again, which is precisely where most amateur money gets into trouble because they assume low involvement means low risk. It means the opposite. It means the risk has just been pushed far enough away that you stop watching for it. Let's talk about what it actually costs to get in. Bootstrapped in local looks like a private bridge or a short toll causeway. $2 to $5 million, usually financed through a mix of municipal bonds and private equity, covering a stretch under 10 miles. You're not building anything, you're buying the rights to an existing crossing, usually one with no free alternative within a 20-minute detour. At this tier, your entire revenue model depends on the geography of a single choke point. One new bridge built by a neighboring county can wipe out your traffic in a single budget cycle. The paperwork at this level is deceptively thin. A handful of easement agreements, a decades-old franchise grant, maybe an inspection report nobody has updated since a previous administration. Small operators at this tier often inherit the crossing from a family estate or a defunct regional authority, which means the due diligence problem isn't financial modeling, it's archaeology, finding out what obligations actually attach to the asset before you sign. Mid-market and regional is where it gets serious. A 40 to 80-mile toll corridor financed through a public-private partnership runs $300 million to $1.2 billion. This is the tier where states hand over operating rights for 30, 50, sometimes 99 years in exchange for an upfront payment they can spend on something else entirely. The state gets a lump sum today. You get a multi-decade bet on population growth, gas prices, and commuting habits that haven't been invented yet.
At this scale, the buyer is rarely a single company. It's a consortium, an infrastructure fund, a construction contractor who wants the maintenance work, and a bank syndicate providing the debt. Each party is optimizing for something different. The fund wants yield. The contractor wants decades of guaranteed repaving contracts. The banks want covenant protection. Those competing incentives get negotiated into the concession agreement itself, which is why these contracts routinely run past 1,000 pages before construction even starts. Institutional and elite means you're bidding against sovereign wealth funds, the Indiana Toll Road, the Chicago Skyway, multi-billion-dollar concessions where the buyer isn't thinking in years, they're thinking in generations because the lease outlives everyone signing it. At this level, the asset isn't really a road anymore. It's a bond with a physical footprint, purchased by pension funds and infrastructure vehicles that need predictable, decades-long cash flow more than they need upside. These are the deals that make headlines when they're announced and disappear from the news cycle within a week because nothing about them is designed to be exciting. A pension fund managing retirement money for school teachers in Ontario doesn't want drama. It wants a toll booth that quietly generates the same percentage return every single quarter for the next 75 years, whether the economy is booming or cratering. Notice the pattern. At every tier, you're not really buying a road. You're buying a legal monopoly on convenience with an expiration date stapled to the back. The size of the check changes, the core wager never does. Here's the mechanism nobody explains on the news. Toll roads don't make their money from cars. They make their money from what's called elasticity management, pricing traffic exactly high enough to keep the road profitable without pushing drivers back onto the free route. There's a term for this inside the industry, the diversion threshold. It's the exact toll price at which enough drivers abandon your road for the free alternative that your revenue starts collapsing instead of growing. Every toll increase is a bet against that number. Push it $1 too far and you don't just lose the marginal driver, you lose the psychological willingness of everyone else to keep paying at all, because now the free road doesn't feel like a compromise, it feels like the smart choice. The second term is availability payment. In many public-private deals, the government doesn't pay you based on how many cars use the road. It pays you a fixed annual sum just for keeping the road open and maintained, regardless of traffic, which means the counterintuitive fact is this. Some of the most profitable toll roads in America barely care how many cars show up at all. The traffic is theater, the contract is the product. That flips the entire mental model. You're not in the driving business, you're in the government relationship business, and the asphalt is just collateral. There's a third term worth knowing, shadow tolls. Instead of charging drivers directly, the government pays the operator per vehicle that passes out of public funds, while the driver experiences the road as free. It sounds generous until you realize it just moves the extraction point from the driver's wallet to the taxpayers, dressed up as a public convenience. Drive the actual corridor and you'll notice something odd. The toll plazas are never where the traffic naturally slows down. They're placed exactly where merging is already difficult, so drivers blame the road geometry instead of the fee. Lane widths near toll gantries are engineered narrower than federal minimum comfort standards, just enough to force cars into a single-file crawl. That crawl isn't an accident, it's a dwell mechanism. The longer a car spends near signage, the more likely a driver notices the express lane upsell and switches over, paying a premium to skip a slowdown the operator built on purpose. Signage placement follows the same logic. Exit warnings for the free toll-free bypass, where one exists, are almost always positioned after the point of no return, tucked behind an overpass or immediately following a curve. Not illegal, not deceptive by any regulatory standard, just quietly optimized so that hesitation costs the driver more than compliance does. Underneath all of it sits a liability nobody photographs for the annual report: deferred maintenance debt. Concrete degrades roughly 2% a year in structural value, but paving contracts are backloaded to year 20 or 30 of the concession, meaning the operator who signs the deal is rarely the one who pays to fix it. The debt gets passed forward like a hot potato, dressed up as an asset in excellent condition right up until the year someone else owns it. There's also the bridge and overpass inventory buried inside most long corridors, structures with their own inspection cycles, their own replacement timelines, their own multi-million-dollar surprises. A toll road isn't one asset, it's dozens of smaller structural assets stitched together, each aging on its own separate clock, and most buyers only model the pavement. Two case studies show how this collapses in practice. The first is the South Bay Expressway outside San Diego. Built for $635 million, largely on borrowed capital, the toll road opened straight into the 2008 financial collapse. Projected traffic never materialized because commuters simply couldn't afford the toll during a recession. The operator filed for bankruptcy in 2010, and the road was eventually sold off for a fraction of its construction cost.
Classic overleverage. The debt structure assumed a traffic forecast that had no room for a bad year, and a bad year came immediately. The second is the Pocahontas Parkway in Virginia. This one wasn't a capital problem, it was a mismatch problem. The road was built to serve growth that the surrounding area never delivered. Drivers had a free alternative that was, for most trips, barely slower. The toll authority defaulted on its bonds in 2012 because the fundamental assumption that people hate their commute enough to pay for a shortcut turned out to be wrong for this specific stretch of Virginia. Sometimes the spreadsheet is fine and the geography just says no. Both roads had traffic. Both roads had tolls. Neither had enough of a gap between free and slow and paid and fast to survive contact with reality. There's a quieter pattern connecting both failures. In each case, the original forecast was produced by a consultant hired by the same entity trying to get the deal financed. The incentive to overstate future traffic isn't a conspiracy. It's just built into who's paying for the study. This is such a consistent pattern that traffic and revenue studies across the toll industry have earned a nickname among municipal bond analysts: optimistic math. Not fraud, just a structural bias baked into who commissions the report and what answer keeps the financing alive. And it isn't limited to failed roads. Even successful concessions routinely miss their first decade traffic projections by 15 to 25%, high or low, because human commuting behavior simply doesn't move in the smooth curves financial models assume. Gas prices spike. Remote work expands. A new employer opens a campus on the wrong side of town. None of it shows up in a spreadsheet built 5 years before the road opens. Strip away the concrete and the contracts, and the entire model reduces to one equation: toll revenue minus concession payments minus deferred maintenance equals whether you are early or late to the deal. Net margins on mature, well-negotiated toll concessions run 25 to 35%, genuinely excellent on paper for something that requires almost no daily operational involvement. Macquarie, the Australian infrastructure giant, built an entire global empire buying exactly these assets: the Chicago Skyway, the Indiana Toll Road, dozens more, treating toll roads not as transportation, but as long-duration bonds with a traffic sensor attached. That's the whole business. Buy the monopoly before anyone prices in the exit ramp. Sell it before anyone else prices in the maintenance bill. Everyone standing on the road when the music stops gets to repave it.